Yes, YouTube is showing.
Is it showing already?
It is.
Yeah, excellent, excellent.
It is 7:01. I
So
am
let 'em in.
letting everyone in.
Great. As folks are joining, welcome to the NWSOFA, which stands for Northwest Suburbs Organizing for Action, Fiscal and Economic Issues Zoom meeting. Tonight, this is the February meeting. We'll start in a few minutes.
Just saying hello, everybody. Glad you could join.
Okay, so we've got a couple of screens full of people already, and I'm expecting more to join. So while they're joining, we'll talk a little bit about the sponsor, NWSOFA. I'm going to share some slides here with any kind of luck. You'll see them in just a few seconds popping up. Or maybe not. There we go. Debbie, let me know when you can see the screen.
I can see the screen, Bill.
All right. Well, this will be the official start. Welcome, everybody, to NWSOFA, which stands for Northwest Suburbs Organizing for Action. We are an indivisible chapter, and we're out of the Northwest Burbs in Chicago. Tonight, we're going to have a presentation by Karl Faulstich and David Doney, who are our co-leads of the fiscal and economic team. They've been doing this for, I'm betting 11 years now. And this should be really a good presentation. As I said, we're an indivisible chapter. We are one of 2,700 chapters. And since January of this last year, we've been growing at 5 to 6 new chapters every weekday. So it's really all those little dots are where we are across the country. There is not a state that does not have a dot. Our goal is to help you understand the facts, sharpen your arguments, and allow you to communicate with your friends, whoever is your audience, better and more effectively. NWSOFA is organized on the twin snowflake principle. On the left, you see our communications team snowflake. That's the orange. On our right is our issue teams, all of the issue teams that we have. And there are 19 issue teams now, 10 on the outer side, which were our standard issue teams until this last year when we started a huge growth. And we've added 9, which are on the inside now, teams of for the organization. And on the left-hand side is our communications snowflake. That's where you get all the emails, all the flyers, the social media tweets, etc. It's a very cool organization to be associated with, and we're growing at all times. And the way we get this done is with our what we call our secret sauce. We have 30 all volunteer leads. Some of these leads work on the communication side. Many of them work on the issue team side. Most of the issues teams have 2 people or more. And similar to, you can see right in the center, Karl and David, who are our leads who will be presenting tonight. A little bit about NWSOFA. If you take a picture or you scan the QR code on the right, you'll be taken to what is known as a link tree. And a link tree will literally allow you just to click, click, click on each one of those yellow bars there, and you can go to various ways to communicate. Um, you can go to our website, you can go to our Substack, you can go to our Blue Sky, our YouTube channel, or you can just go to our contact forms. There are about 15 different ways that you can enter very quickly to know what NWSOFA does. Tonight, we are recording this on a YouTube live channel. If you do not want your picture showing, please take your video off, but we do love to see your faces. And all our videos show up on our website, nwsofa.org. Just click on the tab that says YouTube channel. And once you're there, you'll see literally hundreds of videos from past years. What you want to go is to the live portion, which is all the newest ones. And you'll see them showing like this. Of key that we finally got ourselves registered in Arlington Heights, which is in the Northwest Burbs, for Dutton Park for No Kings Rally on March 28th. We're going to be one of the first ones starting at 10 to noon. And there's going to be almost every burb is going to have a No Kings Rally. And in Elk Grove Village at 3 o'clock, there's going to be 22 organizations that are going to join in mass for a huge No Kings. We're expecting 20,000 people or so that will be there. So as I said before, today is the February NWSOFA Fiscal and Economic Issues Teams. Karl, would you kick us off here?
Okay.
Oh, one last question. Q&A during the presentation. You can ask questions in the chat. You can put a huge Q. You don't have to put the whole word like we show here. Just a huge Q, and then in small case, your question. And David or Debbie will pick that up and we'll signal the presenters that we got some questions coming up. And at appropriate times, they'll break and they'll answer questions. Okay. Karl, it is all yours. Go ahead, please.
Okay. Are people seeing my screen?
Yes.
Great. Welcome, everybody, to the February meeting of the NWSOFA Fiscal and Economic Issues Group. We've got a few topics today: an economic overview, the labor market, budget and economic outlook, household financial measures, other economic measures, and then action.
Can you go to presentation mode?
Sure. Was that better?
No, it stayed the same.
So we'll go to slideshow.
There you go. Got it.
That works.
Perfect.
Because Bill doesn't have his, good glasses on for reading.
You're right. I got the small screen.
So anyhow, things that are going well. In the third quarter, we had strong GDP growth at an annualized rate of 4.3%, driven by spending by higher income consumers and productivity. From January 25, wages were up 3.8%, prices are up 2.4%. Okay, on the GDP growth, this Friday, we will get our first estimate of fourth quarter GDP growth. It's one of the metrics that has been delayed by the government shutdowns. In addition, we will get December numbers for PCE inflation. And then before our next monthly meeting in March, on March 17th, we will have gotten a second estimate of real GDP growth for the fourth quarter, as well as PCE inflation for January. So anyhow, but based on CPI inflation, wages are up 3.8%, prices are up 2.4%, which was a surprising decline in inflation. We'll have to see how that holds up. Stock market is up 16% for 2025. Near record real net worth in the third quarter of 2025 in the bottom 50%, as well as other groups. And record real median household income in 2024, which may have carried over into 2025, but we won't know that until, I think that comes out in September from the Census Bureau. Not so well. Job creation has been pretty much stagnant in 2025. Lower demand, reduced labor supply due to immigration restrictions, firing federal workers, and retiring boomers. There are 500,000 more unemployed than in January 25. That's not a good thing. That said, the unemployment rate for January came in at 4.3%, which was up from a 4% in January of 24, or January 25, rather. So it's gone up a little, but not a lot. Fed's preferred inflation measure was 2.8% in November versus 2% target. Again, we'll get an update on that this Friday and another update early next month. Tariffs average about $2,000 per household in higher taxes or prices, and they tend to be paid to a great extent by people with lower incomes. Middle and lower incomes, not the rich. So what we have here is, if we look at the impact of Trump's policies, we have the tariffs and the so-called Republican One Big Beautiful Bill, which isn't necessarily great. And we see that people in the lower income deciles, all the way up through the 8th decile, so people with an average income of 171 have lost money based on Trump's policies. People in the 9th decile have gained slightly, but people in the top 10% are just raking it in. Too bad I'm not in the top 10%. Retired, I'm closer to the bottom 10% of the, first or second decile. So Trump made a bunch of promises, and this was the New York Times scorecard of how he's done. Their lower food prices, grocery prices are up year to year, so that he hasn't lowered food prices. Gas prices have come down. They were basically flat until just before Thanksgiving, and then Thanksgiving through a month ago, they were going down. And the last month, they've gone up 12 cents a gallon. So we'll see we'll keep track of that. Lower energy costs, electricity prices are up. Revive the auto industry, auto sales are down. Create manufacturing jobs with the tariffs and shutting out imports. And we see is that we've lost manufacturing jobs, which we did under Trump's first term as well. We've raised the stock market 16%. We have the deficit is coming down slightly with the tariffs, but not a lot, pretty much holding even. And the trade deficit is up a little bit. So we'll have to see how that goes. But basically, he hasn't really kept in his his promises. And fortunately for him, he apparently, according to the New York Times, didn't make any promises about job growth, or that would have been a loser as well. So let's look at the labor market, unless there were questions on the economic overview. So in terms of economic data, the monthly employment report is perhaps one of the most important economic news releases. It typically comes out on the first Friday of the month. This month, because of the short government shutdown, it came out a little later. It came out a week later, half a week later. Historically, in order to hold steady, on unemployment, we needed 100 to 150,000 jobs a month. That we'll see that hasn't happened in 2025. Anything above 150 is robust job creation. Historical median was 159,000 and average is 123,000. About 160 million people have payroll jobs. There's a few more people than that are employed doing Lyft and Uber driving and food delivery and things like that are 1099 workers who are not on a company's payroll. The jobs figures are based on a giant establishment survey of employers, although the employers are not responding at the historical rate. Right now, we're getting responses from about a third of employers. And that means that there's some question as to the validity of things in the establishment survey, and those don't get corrected until a year later. So jobs numbers are revised from the prior 2 months as additional data gets filled into the establishment surveys. And there's also an annual benchmark revision, which we will see later in this presentation. So if we look at jobs, we see that jobs were reported to have grown 130,000 in January. But the big news was the benchmark revisions, which tended to revise down prior months. And what we see here is that there were a lot of jobs lost, 22 million jobs lost in 2 months back in 2020. We started to recover under Trump, although oddly in December of 2020, we lost jobs, not quite sure why. And then when Biden took office, we gained jobs. And then when Trump took office, employment has been basically, payroll employment has been basically flat. That's the 181,000 jobs added in total in 2025. So we look at those benchmark revisions that reduced the December 2025 jobs level by 1 million jobs, which was a huge revision. And we see that the revision started in 2023. We're a little more in 2024, and we're bigger in 2025. And this is another way of looking at it. Fewer than 100,000 jobs were revised down for 2023. And then about 550,000 jobs were revised down for 2024. And about 400,000 jobs were revised down in 2025, but it was a huge percentage of the reported jobs. 3-month rolling average of job creation by year. We see that it was pretty good, but going down. But we're still at 150,000 jobs a month being added in 2023, and close to that at the end of 2024. Where in 2025, job creation has gone down from about 100,000 jobs a month. We went negative for a while before going up 130,000 in January. And this is just comparing various presidencies, monthly job creation. And if we don't go by monthly, if we go by total, you'll remember that we lost 2.7 million jobs under Trump in his first term. We've added about 350,000 jobs in his first 12 months of this term. So we're only down 2.35 million jobs since under President Trump. Amazingly good results. And this is just giving you an idea of how many months did we have job losses? How many months did we have decent job gains? How many months did we have really, really strong job gains? And some of the biggest job losses were back with the pandemic recession, as well as many of the very strong job gains were recovering from the pandemic recession. And if we look at the last 12 months of job growth, we see that the big winner is private education and health services, and that's pretty much all health services, as well as leisure and hospitality. We see manufacturing's a loser, construction's a small winner. Somebody's got to build the East Wing. And we've lost a lot of government jobs under Trump. Let's go to the unemployment rate, which is a different metric. And it's not based upon a survey of employers, it's based upon a survey of 50 or 60,000 households. The unemployment rate tells us what percentage of the labor force is not working. Historical average is about 5.7%, going all the way back to 1948 when we started keeping the statistic. And basically, somebody who's counted as unemployed looked for work actively in the past month, is available for work, but did not have a job and did not work any hours during the month. So we see that the labor force is the number of unemployed plus the number of employed. We see when Trump started his first term, the unemployment rate was at 4.7%. It continued down during his first term until we hit the pandemic, and then it exploded. And when he left office, the unemployment rate was 6.4%, which is where it was when Biden took office. And under Biden, it went down and then went back up and was at 4% when Biden left office. So what we have is continuing a trend that's almost unbroken. The unemployment rate goes up under Republican presidents and goes down under Democratic presidents. The only exception on the Republican president side was Ronald Reagan, where the unemployment rate actually went down over his 2 terms. If we look at the data for the household survey for Trump's first year, population grew, the labor force grew, the participation rate dropped a little bit, but the number of people employed grew. Employment population ratio dropped. The number of unemployment grew by almost 500,000 people. The unemployment rate grew by 0.3%. And the number of people not in the labor force grew by a fair number of people. So is that a little over 1 million? Yeah. And not in the labor force includes people like me who are retired, people who are students, housewives who are not looking for work, etc. So house husbands that are not working for work too. Employment to population ratio for the prime age workers. We're basically back up to where we were before the pandemic, and it's been basically flat since we reached that level. Prime age tends to, starting at 25, we exclude a lot of students, and ending at, that's not what I wanted to do. Ending at 54, we exclude a lot of early retirees. So that's a reason why it's a subset that we like to look at, or economists like to look at, that is not as influenced by students and retirees. Job openings are down, and job openings are now below the number of unemployed, which has not happened since we recovered from the pandemic in the middle of 2021. Okay, do we have questions on the first couple of sections?
We did, Karl. I've answered a couple of them in the chat. I'll just mention one of them was kind of explain the benchmark adjustment a little bit. I attached a CRS link in there it explains it. It's pretty technical. Karl, I don't know if you want to try to explain it, but there's a whole bunch of things they do. All I'll say is it's routine that they do it every year.
Basically, companies have to file unemployment taxes for all their employees every month. And the adjustment tends to be looking at those unemployment tax returns to count up how many people were actually counted by employers as employed. And that's a much bigger survey than the 1/3 of payroll companies that are encountered in the payroll employment survey.
Another question was around business formation statistics. We'll add that to our list. We'll bring that into one of our future presentations. And I sent Rita a link on that from the Census Bureau. They have a page, a website that goes into that in detail. So you can hunt around in there a little bit and see it. So it looks like Rita's been looking at it. So happy customer there, but it's a series I haven't looked at very much. So I'll take it as a note and we'll take a look at it in one of our future presentations. That's it for that section, Karl.
You want to handle the budget, or you want me to?
Yeah, go ahead. You do the budget. You're on a roll.
Okay.
If in the middle of it, there's a budget part, then the economic part. If you get tired of doing budget, you can hand off to me for the economics part of it.
Okay, so these are future budget deficit projections. So we see that for fiscal year 2025, we were at 1.8 trillion, I think. We expect our current fiscal year to be a little higher, and the year after that to be a little higher, and then go up in fiscal year 2028, go down a little bit in fiscal year 2029, before starting to go up again. And a big part of the growth of budget deficits is the aging population and more of us qualifying for Social Security and Medicare. Another thing that's happening is that interest rates have gone up, as well as the total debt. And when total debt and the interest rate we pay on the debt both go up, our deficit goes up. So what we see is that actually starting in 2026, our primary deficit, part that we control directly, is going down a little bit, but the net interest outlays are going up because debt has gone up and interest rates are going up. And basically, if we look at what's happened to the CBO's 10-year baseline from 2026 to 2035, the projected deficit has gone up by about $1.4 trillion after we've incorporated Trump's policies. And if these tariffs are knocked down by the courts, these will go up even more. And we see historically, we had deficits except for a few years at the end of the Clinton administration. We went back a little further, we'd see that we had a surplus in fiscal year 69, the LBJ's last budget. And then we have to go back to the 50s to find surpluses before that. So we've got mandatory outlays, which are growing at a small pace, discretionary outlays, which are going down at a decent pace, and net interest outlays, which are going up at a fairly high pace. And mandatory outlays, as shown in the right-hand column, are things like Medicare and Social Security. Discretionary things like defense. We look at revenue by category. We see individual revenue, income taxes, payroll taxes, corporate income taxes, customs duties, and the customs duties would include tariffs. So debt has risen from around 100% of GDP, or is projected to rise from about 100% of GDP up to 175% of GDP by 2056, if we don't make any changes in the law. Actually, it's going to projected to go to 120% of GDP in 2036, which would be the highest it has been in our history, even after paying World War II debt. Economic outlook. Real GDP growth is projected to be relatively small, around 2%. Almost 2% last year, a little over 2% this year, and a little under 2%, 1.8% going forward. PCE inflation is expected to be 2.7% this year, and going down towards 2% by 2029. Consumer prices are expected to go down to 2.3% by 2029. Payroll employment increases. Interestingly, the Congressional Budget Office did not get to include the most recent adjustments. So they showed an estimate of average monthly employment gains of 70,000 in 2025, when I think the actual number is closer to, can't do that math in my head. If anybody has their calculator handy, but
Like 17 or something.
yeah, 7007, something like that.
Yep.
The unemployment rate is expected to grow this year before coming down, but it's not expected to go crazy. Interest rates are expected to go down. Ten-year Treasury notes are, shorter term interest rates with the Fed controls are expected to go down. 10-year Treasury notes and then mortgage interest rates, the Fed has less control over. But even then, we're at about 6% for mortgages, which historically is a really good mortgage rate, just not a really good mortgage rate for the last 10 years, when a lot of us got in at 3% or less. And basically wages and salaries as a percent of GDP basically are going to hold even, as well as domestic corporate profits are expected to go down slightly. Just for those of you who are younger, the highest mortgage rates were back in the early 1980s under Reagan. I think they reached 18% one month. By 1986, I was able to get a 10% mortgage, so I was really happy because they'd come down from the 18% to 10%. Real GDP growth, these look like annual numbers. And we see that they tend to go down during recessions. And then go up to recover from recessions. And again, this is where we're expecting them at 1.8% going forward. And this is job creation, again, from the Congressional Budget Office. So we see that most of these numbers are as reported. 2025 is not, because this is showing, I think, 70,000, and David said it's really 17,000. And we'll have to see what it ends up being in 2026. At 130,000 the first month is a good number. And if you discount the government jobs that were lost, we reported about 150, 160,000 private sector jobs added, On the other hand, ADP, which also does a survey, a payroll firm, they estimated 22,000 jobs added. So there's a huge discrepancy, and we'll see how that gets revised over the next year and a half once we get all of those unemployment returns. PCE inflation so far has only been reported through November. We will get the December PCE inflation number on Friday, and we'll get the January number in early March. So they're starting to catch up from the shutdowns, but I'm not sure how good the numbers are given the shutdowns. So we'll have to see. So the 10-year interest rate is resistant to the Fed funds rate reductions. Fed funds control shorter term rates, but not longer term rates. Okay. Looks like somehow my presentation jumped ahead, so let's back up.
You can hand off to me here, Karl. I can share.
That's probably a good idea.
Right.
I'll do my stop share. So were there questions on the last section?
There's one about young people not being able to find jobs, or they're getting laid off and they're wondering about the unemployment numbers. Are they reliable, and is it representing just how difficult it is out there for people to find a job?
Well, I think that they're probably fairly representative, but the unemployment rate for young people has been going up. So it's reflecting the fact that it's tougher for young people to find jobs.
Karl, can you see the screen?
Yes. Looks like Paul Trottier has his hand raised.
He does.
So he can put himself off mute and ask a question.
Yeah, hi, thanks for your presentation. I think you have a lot of great information there. What I'm concerned about is the accuracy in terms of the intention of the administration to spin things better than what they are. That was a concern, like several months ago, but then it kind of was forgotten. And I'm wondering, with the new appointment at the Department of Labor, for instance, is the credibility lost or unknown?
I would say it's unknown. We don't have any information that the Trump administration is manipulating the data, other than the fact that because of the government shutdowns, there's a lot of missing data.
I mean, it's possible the inflation rate is a little bit understated right now. There were some technical issues with how they handled it, and they've explained that. So economists don't have an exact view, but there are some measures that we'll cover with you here in a minute. We'll tell you if we think the numbers start looking really unusual. For example, if I were the president and I were controlling and manipulating the numbers, I would not have had no job creation in 2025. That was terrible job creation. It turns out I did the math while we were waiting here. It's 15,000 jobs a month. And Karl, I think, mentioned it earlier that like Biden was averaging, like after the pandemic and after we recovered the jobs to the pre-pandemic level, he averaged like 190,000 jobs a month. So from like July of 2022 until the end of his administration, he averaged like 190,000 jobs. And that's per month. And Trump had 181,000 total in 2025. So if you're manipulating the numbers, you're doing a terrible job for the president. That guy would get fired by, so, I don't think you're seeing much manipulation in the labor market numbers, and I think they've explained that, and that's from the Bureau of Labor Statistics. They also do the inflation numbers, and they have said there were some things that they did that may result in these numbers being a little bit understated, but we will see. And I'll explain to you why that may or may not be the case in reality. So we'll cover that here shortly. But we do this presentation every month. I can assure you that if we start to see reason to believe that things are being manipulated, we will tell you. And one thing I did a couple months ago was, before all the adjustments, I looked at the payroll taxes that the Treasury Department is reporting per worker over like the last 10 years to see if that ratio is off, like the amount of actual cash that's being collected for payroll taxes at the Treasury Department versus what the Bureau of Labor Statistics is reporting for jobs, and they were consistent. There was nothing in there that was indicating something was wrong. Now, they could have manipulated both numbers, but it's really hard to manipulate a big cash number like the payroll tax collections. Banks are going to see it. Other people are going to see it. And I've mentioned before, the reason I think we can be fairly confident in these numbers is because Wall Street wants accurate numbers. They're the big guys with lots and lots of money. They want accurate numbers. So we've got that on our side. But we're here every month. We'll tell you if we start to see economists saying things are looking manipulated. Last month, we shared a slide from a guy who worked for the Obama administration, his Council of Economic Advisors. And he said he thought the numbers were not politically manipulated. He's saying they're having some difficulty collecting them and reporting them, but he said that, it isn't because somebody has evil intent. I got to use an old Latin word. Is it scienter? S-C-I-E-N-T-E-R? I haven't used that word in like 20 years. No evil intent by in the ranks of the bureaucrats doing the numbers.
If we continue to see a huge divergence between the ADP numbers and the BLS numbers, that will be a cause of concern. A 1 month divergence like this raises a yellow flag, but not a red flag.
Yep. And we can share that next month. We'll show you the ADP series versus the government one, and you can take a look at it. That'll be private sector only. But right now I don't think we're seeing big fluctuations in terms of the government piece. They laid off a ton of people, and I think they more or less have stopped that. There's not a ton of movement over there. All right, so let me share this here. Usually around 8 o'clock or a little bit after, we take a break for about 10 minutes. And so I'll go for a few minutes here, and then we will, Karl, remind me if it's 8 if I don't stop. And we will grab a break, or Debbie. So the real median household income is a great measure of the middle class and how prosperous it is. And that was at a record level in 2024. Just above the previous record, which was in 2019. So we moved down during the pandemic and then back up in 2024. Real means inflation adjusted. So remember that. And usually they pick a year, like it says here, $2024 over at the left of my screen. Usually what you'll see some real wage numbers from me in a minute that are in today's dollar. So November 2020, or they'll be January 2026. Well, what's the latest month? We've got December inflation statistics. So we'll have the December numbers. No, wait, never mind. I'm sorry. We have the January inflation. They'll be in January 2026 dollars. So this is actually very good news. This shows a trend of people having more purchasing power, and also because you had two people working in households over time. That's good news and bad news, but households have more purchasing power with the two workers often than we've ever had in our history. Wages have also outgrown inflation if the starting point is 2020, just before the pandemic. February of 2020 is considered the last sort of pre-pandemic month. And so throughout that time, wages have outgrown inflation cumulatively. They got pretty close here in 2022 where that inflation really picked up. But what this means is that the real wage, the purchasing power of the hourly wage, was always more than it was before the pandemic. We were never worse off in terms of this measure. And I'll show you what that measure is in dollars per hour in a minute. But since February 2020, wages are up cumulatively 33%, and inflation costs are up 26% cumulatively. And that's a good news. That means we have more purchasing power now than we had in 2019, and everybody loved 2019. So, and this was true throughout the Biden era. I'll show you this in another way. Here's the actual wage itself. So these are the dollars per hour. Again, real, adjusted for inflation. We had this fake pandemic peak here because a ton of low-wage workers, think hotel workers and restaurant workers, lost their jobs. And so the average of the people that were still working was much higher. So this is fake news here. And the BLS, Bureau of Labor Statistics, explained that. They said this number is off because of these reasons. And as people returned to the workforce, this number came down, and also came down because we had more inflation. But again, it never got below February 2020. It got close. That's here. It got close, but it was still above that pre-pandemic real wage. And since then, it's been growing consistently. We had this gap here because of the shutdown, so there's no data. You'll see this on a couple of slides. And here we're at really the record level, excluding that fake pandemic peak, which I think you can ignore. If you were to draw this chart all the way back to the 1960s for this data, there was a big peak in the 1970s, but it wasn't quite as high as this one. It was just a little bit lower. So we've got really record real wages right now. And the Congressional Budget Office said it's not just an aggregate number at every quintile of the population, meaning if you split the population into the poorest 20% to the richest 20%, all of the groups have more purchasing power. They had more purchasing power in 2023 than 2019. So that's kind of in the middle of the chart I was showing before. That's in here. In 2023, they were doing this analysis. They reported it in 2024, but it was data through 2023. So this is another way of saying, how badly are people suffering from an income relative to inflation? They're not. Here, the dollar has weakened over the past year or so. It's down about 10% relative to the dollar's down about 10% relative to the euro. And there's good news and bad news when the dollar falls in value. Exports are cheaper for Europe to buy. So if you're a US exporter, you're making equipment that is sold internationally, you're happy to see the dollar fall. And then vice versa, imports from Europe become more expensive. So if your goal, like Trump's, is to reduce the trade deficit, then weakening the currency is one of the ways of doing that. If you're a US company with a lot of euro-denominated business, or when you translate that to US dollars, you see big gains. And that's part of that really strong profit picture for US companies that's helping drive the stock market. Tourism becomes cheaper for Europeans. They can come here more easily. And it becomes more expensive for Americans that want to go to Europe. That conversion rate is working against you. You get sticker shock when you go and convert your dollars into euros. So it's and there's a few other points that are in here, but just understand that a weaker currency is not necessarily bad for the US. People often talk about, oh, the dollar's got to be strong. And just the other day, Trump was lying, saying the dollar's stronger than ever. And it's like, well, not really. It's about 10% off its recent, a year ago. So this just says that a dollar used to buy you 0.97 euro, and now a dollar buys you 0.85 euro. It's just weakened. If you look at how these household measures have changed since Trump started, so January 25 to January 26, and these are monthly averages if the data is more often than monthly, like the stock market. Stocks are up about 16%. Electricity is up 6%. wages up almost 4, rent 3, inflation 2.4, groceries 2.2, gasoline down 8.7. So these are, the green is good news and the red is bad news. But the key thing of all this to take away is wages have outgrown inflation. We have more purchasing power now than we had a year ago. That is the big takeaway. You don't want to look at inflation by itself. You can score political points by saying things are more expensive. And Republicans exploited that mercilessly under Biden. And we didn't have an effective way of saying, yeah, but the wages have outgrown that. And so you're better off. People got really angry when we did that. It didn't poll well to tell people the truth. And so all this data that I've shared with you, it did not resonate with voters. But this is what's happened since Trump came in. So other than your electricity bill, these other inflation amounts are fairly tame. They're not unusual in historical context. And that's pretty much what always happens. There have only been 3 years since 1948 when the overall price level went down. Only 3 years. And the largest year was 1% in 1949. Prices don't fall overall. It's just not a thing. You know, prices can fall in certain areas. Gas can go down or up, eggs can go up or down, but overall, you're almost always going to see positive, an inflation number that's bigger than zero. And it would take probably a severe recession or depression to move prices negative. You know, even in the Great Recession, prices barely fell, like some fraction of a percent for 1 year.
Well, during the pandemic recession, we saw some big drops for short periods of time.
Yeah.
I mean, when Trump told everybody to stop driving and stay home, people stopped driving and stayed home, and the spot price of crude oil actually went negative briefly.
Yeah.
And gas prices went down in some places below $2 a gallon. I got some great deals on meat for a couple of months because people weren't going to restaurants, so they weren't buying the high quality steaks. But that was an anomaly and not something. And for the year as a whole, prices did go up.
When you look at the measures since before the pandemic, and here's inflation at the bottom around 25%, and this only goes through the third quarter of 2025, so it's going to be a little different than the number I showed you a second ago. This is the last quarter when we have the net worth data. That data tends to lag about a quarter. The bottom 50% group, 100% increase, it means it doubled. So the net worth of the bottom 50% has doubled since before the pandemic. And then on down the line, the stock market doubled. Net worth of the 50th to 90th group, so the upper middle class, 66%. Home prices up 50%. GDP 42, hourly wages 32, inflation 25. So most objective measures put households in much better shape than they were in 2019. Now they're just as unhappy as they were during the Biden era. They're very upset about the economy when you look at different polling of people and how happy they are with the economy. Their views are very disconnected from the actual numbers, the hard numbers that are released. And we talked a couple months back about affordability and what that really means to people. And we're not going to get into it in depth today. If you were with us a couple months ago, that presentation we covered kind of how people view affordability in different ways. It may not be based on these numbers at all. It may be on seeing billionaires spending $50 million on their wedding while they're just trying to put their kids through college, and they get angry seeing this wealth waved in their face, knowing that we could be taxing those people. And there's so much money out there that they could be paying for all this. And I have the slide. Let me move up a little bit before we take the break. One of my favorite slides that I put wherever I can is that the household net worth in the United States is about $173 trillion. And the net national debt is only 38. If somehow, and I'm not proposing this, I'm simply saying in terms of scale, the top 1% have 54 trillion. If they were somehow forced to pay down the national debt, if they could somehow without crashing the system, if they paid it off, they'd still have 3 times the net worth of the bottom 50%. These guys would still have, if they paid off the 38, they'd still have what, 14, 16 trillion or so. And the bottom 50% would still have 4. So, I mean, it's 4 times, you know? So again, I'm not proposing that, and it wouldn't be that simple. You can't just extract all that money from people, but there is plenty of money out there that you could tax the rich very, very aggressively and pay for a lot of stuff for the middle class, and the middle class knows this. So that's why I think when you get into affordability, I think it really means the economy doesn't get much better than it is now. We showed you those numbers before. It just doesn't. You're not going to get much better than this. 2019, people thought was the greatest economy ever, and look at this. I mean, we're like double where we were. Even after adjusting for inflation, we're in tremendously better shape. So it's something else beside the hard numbers that people are upset about. And your guess is as good as mine. I gave you my theory a couple months ago on it, and we'll revisit it. We'll probably talk about it at some point today. But let me pause there, and we'll take our break, and we'll resume about 8:10. Usually Karl and I will stay on if you have any burning questions. Otherwise, we will pause at the end of certain sections for you guys can ask questions, and we'll go from there.
And David and Karl, just to let you know, we do have some questions, starting with Chuck's question at 7:50 p.m. So just so you know.
Excellent. I will take a look at those. I'll go look at the chat while we take a break, and we'll be prepared to answer them when we get back.
Okay. Thank you.
Karl, I noticed that there seems to be a lot of questions in the chat. A couple of them have replies, so I'm thinking that maybe David answered those. Yes, he did. Okay. You may want to look at that.
Okay.
Interesting. I see a couple comments about medical debt, but well, there is one on insurance coverage also. I would expect we should start seeing some of the increases in insurance bills popping up here.
Yeah, the big bumps on ACA policies are for people who make over 4 times the poverty rate, because the subsidies continued for people up to 4 times the poverty rate. And on food inflation, President Trump celebrates the fact that egg prices have come down a lot since he took office. Fair enough. We had some sort of bird infection epidemic, which was causing egg prices to be higher. And recently, I've gotten eggs $2 a dozen, and I've even seen them as low as $1 a dozen. For all the Catholics who have Lent shopping, Jewel has 1-day sale on fish and seafood tomorrow, including 4-ounce lobster tails for $4, which is a pretty good price. And of course, what President Trump doesn't celebrate is the price of ground beef.
Karl, if you have a chance to put a copy of your slides, a link to your slides in the chat.
Sure.
I see a couple of people asking for that.
I can try and do that.
All right. Question for you, Karl.
No.
I knew you were going to do what I knew that.
My standard answers are no and 3.
Just a question on that, on the beef. Are they importing from Argentina yet, or?
I don't know how much, if any, beef we're getting from Argentina and other imports.
Okay. Thank you.
All right, so we are at 8:10. There are some good questions there in the chat and some good comments, so thank you for that. Karl has put a link to the slides in there, so you guys can all see that. It's near the bottom of the list, and we'll probably post it a couple more times, so you'll have it. And then this stuff will all be on YouTube, where you can also see it shortly. An interesting question around, again, the affordability thing is something that is a big deal to people. And we talked about it a lot last month. We'll talk about some of it here, it looks like, based on the questions we're getting. One of the questions was kind of, how do you handle sort of student loan debt and other pieces in sort of the affordability calculus? And when it comes to wages and inflation, student loans are not going to be in the inflation number. Um, the cost of education and other things are represented in some of the inflation numbers, but how much student loans you have is sort of a liability. It's a debt that you have. And if you're going to do the math on that, you would have to also offset that against your assets, meaning do you have a 401k or something else? So things like that, some of the financial kinds of things, your credit card debt, those things are the interest on your credit card debt, that stuff is sort of related to your debt, and that is not part of the inflation computation. And I've seen some studies where they tried to put all that in there, but if you do, you got to be careful because you got to layer in all the assets, and so that things gets really complicated. Now, things like there's a note about kind of, let me go back up. It's not the one I was looking at here. Where was it? Sorry, I lost my train of thought when I was looking at this. We're getting some interesting anecdotes on how much people are spending on individual things. Phoenix lobster tails are now at 7. You can eat chicken, just so you know. There are other things that you can eat beside lobster tails, if you are into that. So
Well,
that's,
as I mentioned before you got back, 4-ounce lobster tails are on sale at Jewel tomorrow for $4.
excellent. Good to know. That's our lobster fans are there. So, I mean, it's one of the things about, we didn't get into it in this meeting, but one of the big differences between the CPI inflation and the Fed's preferred measure, the PCE inflation, is you can substitute goods, and the PCE number reflects substitution a bit better than the CPI inflation. And so if somebody finds that beef is really expensive or their lobster tails are really expensive, you can buy beef or chicken, assuming that those aren't as expensive too. If one of them's on sale, you can get your protein elsewhere. But people are clearly not happy with this. They don't believe these numbers are representative of their reality. And we do our best to explain this stuff. You'll hear statistics like 60% of people live paycheck to paycheck, but if people tend to, the counter argument to that is people tend to lift their income, their spending along with their income. People can say, I live paycheck to paycheck and I make 300. I'm not saying I personally, but a person could say, I make 300,000 and I live paycheck to paycheck because I've got a fancy car and a fancy house and send my kid to private school and I live paycheck to paycheck, and so you got to take that statistic with a grain of salt, even though Bernie Sanders loves it. When you dig into those numbers, you'll find sources that support it, but it's questionable because of that tendency of people to lift their cost base based on their income, which you would think they would like to. I mean, why kill yourself working crazy hours in a tough job, making a lot of money if you're not going to increase your material, surroundings? So it's not always cut and dried on those numbers. Economists really don't like that. We live paycheck to paycheck. They like real wages. That's what, and that real median household income number are things that carry great weight with economists. So keep that in mind. Question, I see a Pamela question over here.
I'm sorry, this is making me furious.
Here we
Averages include the very wealthy in this.
Medians do not.
That's fine. The lack of ability to control one's life and the necessity for 2 incomes in order to have the same standard of living that we had as children on 1 income isn't being measured here. And the fact that our massive numbers of workers who can't survive without government subsidies, this is not being looked at. The number of people in each quintile, that makes a difference too, not just the amount of wealth.
Yeah, this is you're not alone in this view. Yeah,
The
this is,
higher cost of poverty, it's not the wealthy who are paying massive interest on credit card debt. It's not the wealthy, it's not the middle class who have to use payday loans because they can't get bank accounts, who can't get jobs because they don't have health care. I mean, they don't have child care.
yeah,
The only thing they can get until they get a better job is subsidized health care.
right.
But that doesn't do them any good if they have to work and there's nowhere to put the children.
Mhm.
The cost of child raising has skyrocketed. The cost of education has skyrocketed. The cost of computers has gone down.
Right. Yep. Yes.
The-
Yeah,
the-
these are good points. I mean, this is why people are so angry about the affordability thing, because you look at all these numbers and they're all very good. Even when you go like with the CBO study, it shows every quintile had more, their income outgrew the inflation that they faced. And that is, but people don't believe it. You know, they don't think
It doesn't
that's
matter
fair.
if you weren't able to make a living before.
Yeah,
It doesn't matter how much more
yeah.
closer to the surface of the water you get if you're still under it.
Yeah. And people in 2019, there was no affordability crisis in the news in 2019. You didn't hear affordability. That happened under Biden. And then now, you know, and we've shown you the data that even under Biden, things got better compared to
You're,
before the pandemic. So even though we're better off on almost all these numbers, people feel worse off. And they're
the,
just getting angry. They're getting really angry. And it's you know, and I think it gets back to the idea that they know the money is there, yet it's not being deployed to help them, that the rich are getting it all. If you want to address
that's right.
affordability, you're talking about taxing the rich to pay for stuff for the middle class, pay for college, pay for childcare, pay for
Actually, you
elder
don't
care.
have to tax anybody. The government can simply invest directly.
It can print the money and pay it, and then you may
That's
or may
right.
not, you can get
Like we
significant
do
inflation.
for the military already,
Mhm.
and like we do for wars, and like we do for tax cuts on billionaires.
Yes. Yes. Yeah, that
And
trillion they gave
there's
to the
no,
top 1%
if we
over a decade.
remove the salary contribution cap from Medicare, then it would fund itself forever.
Social Security,
Social Security is
about
what I
six,
mean.
it covers about 60% of the Social Security shortfall if you do that. It used to cover more, and now it's less. But yes, I get your point. I mean, we tax
Just
the rich
remove
more.
it entirely.
Yeah, because the economy is not going to get good enough to make things feel affordable to a large number of people. You
What
have
if
to
we had a
redistribute.
carbon tax
You
and
can't.
paid it
I
back to
mean,
people?
you're going to have to tax rich people and pay for this stuff eventually. You can pay for it now if you want, and your deficit is going to shoot through the roof, and then you're going to get the concerns about deficits and debt and inflation and
No,
this
you
and
get
that.
that from the
You can't.
conservatives whenever the Democrats have power.
That is true too. That
You
is true.
don't get it from them right now when they're ballooning the deficit with massive tax cuts.
Yes. Yep. And we're going to see that start to hit in this next fiscal year. We'll see what it does.
Where is the extension of the Medicare, the Medicaid subsidies?
Yeah, that was canceled. It did not extend. Yeah, they didn't extend them. So this is why we
No
need as many
excuse for that.
we need as many progressive Democrats as we can get into office so we can do this, because we're not going to get these things, you know, we're not going to get them without paying for at least some of it. And it's going to take a lot of work to get that many people in there, because the economy will not do it. These numbers can't get much better than this. They are historically as good as they get. It's not like there was an era when we had better. You know, you mentioned back in the 50s or 60s or 70s when it was better, but the houses were a quarter of the size or half the size. You know, and that's so the things that our lifestyle has changed so much. Our cars have cameras in the rear view. They've got internet connectivity. You know, our lifestyles have changed enormously different from what was going on back then. The kids slept in the same room. They didn't all have their own bedrooms everywhere. You know, the houses after World War II were like 1,000 or 1,500 square feet. Now they're 2,000, 2,500, 3,000 square feet. The world has completely changed since then. So we're not going to go back there, but these numbers are as good as they're going to get. If we got to vote for people that'll do redistribution, that's the only way we're going to get to affordability. Let me move on. I hear you, and you're not alone in that concern. Dr. Sue is raising her hand.
All righty.
I completely agree with Pamela. I think we need to recalculate these numbers based on the true increase in the cost of living as opposed to based on inflation. For a time, my dad and I were wondering what on earth is going on with, supposedly we have higher income and people are saying, that there's a lot of economic anxiety out there. And he and I really got into each other's finances and compared how much various things costs.
Mhm.
I think there was a lot that was hidden income in his generation. For example, pensions, those were effectively hidden income. That wasn't counted as income, but boy, did they benefit from that. And health insurance subsidies, where workers had to spend a lot less for their portion of health care that back then than they do now. I think there was a lot of hidden income in their income, and someone needs to account for that. I'll bet you some brilliant economist has, and redo these numbers, including hidden income, and see whether we really do have more quote unquote disposable income. Income is not disposable if you have to use it to get the amount of insurance that your parents had without having to pay for it. And really, the parents kind of their employers paid for it, so we should have counted that as hidden income for the parents. And hidden income is not disposable if you're effectively required to put it into your 401k because you don't have the pension that your parents have. So I think we need to kind of go through these numbers more carefully and see whether really we are increasing a, a correct amount of increase of disposable income. I think these numbers miss some of the hidden income that we used to have.
Well, thank you for volunteering to take on that project. We'll look forward to your presentation next month.
We'll take a look. No, we'll see what we can find. I mean, there was a study a couple of years ago where they tried to put in a lot of the financial pieces in there. They tried to put in like the cost of credit card interest into inflation and different things, but they didn't do a great job on the asset side. And so I looked at that study and I was like, well, if you're not going to really put the effort in on the asset side, I can't really put any weight on this. But yeah, if you double the inflation number, if you pick some assumptions and you say, well, inflation is really twice what it is, then yeah, I mean, these numbers are going to look bad. But on the other hand, what are you going to do with those asset prices? I mean, when the stock market has doubled, I mean, lots and lots of workers have 401ks, most of it's concentrated with the rich, but you've got about 60% of the people that have some interest in the stock market. And their 401ks are at record level. They're double where they were 5-6 years ago. Go ahead, Doc. Go ahead. Dr. Sue.
Yeah, I agree with you. Someone needs to go in and account for all of that because the economic picture, if you miss a couple numbers here or there or misallocate them, then you get the wrong conclusions. So someone really needs to go in there and account for all of that, including assets.
No. I'll look around, I'll see what I can find, and we can cover that study that I mentioned. I forget, I know that Larry, I'm going to forget his name now, the Harvard economist, what's his last name?
Kudlow or
Say that again?
Kudlow or different one?
He was the Harvard president. He's very famous. He was a Treasury Secretary under Clinton. Larry, what the heck is this? Oh, hold on. Let me just look it up here. It's Kudlow. He's a
Crazy right wing.
Larry Summers.
Yeah.
Larry Summers didn't do the study, but he sort of added his name to it to kind of give it some reach, and a lot of people saw it a few years ago, and that's where they came from, was sort of the finance side. So since we're talking about that, let's talk about a little bit of what this looks like. The personal savings rate is how much money is left over after people have take their income minus all their spending and taxes and everything else. How much is actually left? And I'll show you the actual numbers here in a second, but the personal savings rate, when it's above 5, you can think of that as healthy. So we were above 5 for the end of the Obama era into 2019 and 20. And then you had the pandemic, which with, giant stimulus checks and people couldn't spend their money. So you had this enormous, crazy savings rate. And then it's come down, but lately it's fallen down into this 3.5 range. It was about 5.1 when Trump started. So what this means is people are sort of pedal to the metal spending. And the question is, well, is it because they're buying the same amount of stuff, but it's more expensive? Or are they buying more stuff, even though it's more expensive? Because we know prices have gone up. So let's answer that question. So a lot of numbers on this page, but not as bad as it looks. The idea is that you have compensation, if you own a business, you've got proprietor's income, you've got rental income if you've got a rental investment that you give out, you've got all your income on your assets, so your interest and dividends. The government is paying transfers, so this would be Social Security or Medicare benefits, less what you're contributing to Medicare and Social Security, less personal taxes, your income taxes that you're paying out, and that equals disposable personal income. And then that's what you can spend. And then what you choose to spend or are forced to spend are your outlays. And that equals your personal savings. And these numbers are, this 1276 that's billions. So that's almost 1.3 trillion. And these numbers are annualized. They're monthly, but then they are annualized as reported. This is December 2019. This is December 2019 adjusted into November 2025 dollars. So this is real. So all these numbers have been grossed up because we've had inflation. And so that allows us to do a comparison to November of 2025. And what you can see here is that, compensation has gone up. The income for the providers hasn't really changed. Rental income, you can go through the list and see where we went up, where we went down. Just understand these negatives mean more negative, meaning these numbers got bigger, but they're treated as subtractions here. And then the disposable income, though, so it was up almost 2.1 trillion more in disposable income versus the pandemic, but people spent 2.9 trillion more. And again, this is adjusted for inflation. So people wiped out all these other categories were wiped out by outlays, and so this number has fallen by 800. It went from 1603 to 800 between December of 2019 and November of 2025. You had this very large decline, and it was driven here by outlays. Let me show you that picture. This was personal savings in December of 2019, 1.6 trillion. Then you had compensation, government transfers, other income adding to that. And then you had taxes and outlays taking away from that, outlays being spending. And that got you to 800. So the personal savings was cut almost in half. But where did it get cut in half? It wasn't because we bought stuff at higher prices. We bought more stuff. I've adjusted for the higher prices here, at least, again, with the measures that they use now. And it cut the personal savings almost in half versus where it was before the pandemic. And it's here, people buying enormously more stuff. People are buying more things. So the question is, who's doing all that buying? And this is a big debate happening right now among economists talking about the K-shaped economy, that all this extra spending, is it rich people doing all that extra spending? Ernie Tedeschi, who's an economist he's a liberal economist, worked for, I believe, Obama or Biden, one of the two. He says it's not just the rich, it's everybody. There is a tremendous amount of spending going on right now. People are choosing to spend, even though these numbers are adjusted for inflation, they're getting more stuff, not just the same stuff at a higher price. And so that's why these numbers, the personal savings rate, when you look at December 19 to November of 2025, was cut basically in half, from 7.6 to 3.5. And it wasn't because prices went up. It was because people are choosing to buy a lot of stuff. Now, is that because of anxiety? Are people really nervous about things that are going on and they're spending for those endorphins? But it's not, the inflation is not in this number. So Pamela is ready to throw something at the screen. She's her. I don't blame you. I'm just showing you the numbers, right? I'm just the messenger, but I'm telling you, it looks like what's happening is people are really spending. And part of it may be because the stock market is up so much that they feel like they don't need to save. They're just going to buy something, go on a trip. We had the whole craziness with, I think one of the great examples was the whole tour that, who's the singer that is Taylor Swift. This lady was on the news. She's like, I had 6 Taylor Swift tickets for my kids and their friends, and I had to sell, 4 of them. I don't know how I'm going to pay I had to sell 4 tickets to pay the rent. I'm like, oh my God, so what is this? But it's just, the numbers indicate that there's an enormous amount of spending going on. And that's part of why you've seen these big GDP numbers, even though there's no jobs, no job creation, people are just buying. And I'm assuming it's got to be rich people because poor people don't have the money. But there is debate among economists on that. Even somebody that's normally liberal in our camp, Ernie Tedeschi's like, that's not what the data is showing me. It's everybody. So let me pause there for a minute because people are trying to blow up their televisions.
David,
Paul has a hand up.
Yes, he does. And I have a little bit of an insight as to why it could possibly be due to the threat of tariffs, maybe. Just a thought. Okay, Paul, go ahead.
Yep.
Yeah, hi again. I think that what is missing here is the quality of life. And when I say quality of life, I mean like the quality of the air we breathe, the water we drink, the soil we grow our food in, and other important things like that really determine our lifespan and the quality of our health. A lot of things go into that. In addition to that, I have a whole litany of things that could be considered as quality of life metrics. And I think that when we look only at the material side, and quantitative dollar amounts and all of that, we're missing really the larger picture of what really is important to people.
Okay. I think you've done this before, and I apologize. If you could put a couple of links in here on that, because I know there is a theory that around GDP that it doesn't reflect a lot of these other aspects. So yeah, on one hand, we've got, cameras on our cars so that we can see. We've got sensors that tell us if somebody's in our blind spot. We've got like radar in our cars that tell us if people are around. But yeah, but are we drinking water that's worse? Is the fracking that's driving the economy in some cases poisoning people's wells? There was an interesting article on where was it? Starts with a P. I'm going to forget it now, but they talked about a person who in Oklahoma where their well water was being destroyed by the oil, the seepage from an oil well that was nearby. They had water that was incredibly toxic and salty. They were drinking salt water in their home and bathing in it, and they, it was really hard for them with the deregulatory environment we've got now to really get action taken. The regulators didn't want to act because of the Republicans. Probably they didn't want to go after a big oil company. So it's this kind of stuff that's out there, and that was just a great example, I think, of what you're saying is that there's a person's quality of life got trashed because they can't drink out of the well that they're for their home. Other questions? Pamela doesn't have her hand raised, even though I think I know what she would say. She was ready to throw stuff at the television. She had a beanbag. She was ready. So
Well, you spoke too soon there.
I shouldn't tempt her because I know she's going to go off.
She's tempted.
You know
Go
what, though? It's
ahead.
good counterpoint to us. Karl and I are here. We're like, here's the data, the best data we've got. People are like, we don't believe it.
You're muted, Pamela.
Okay, Pam. Unmute yourself. There you go.
They weren't letting me unmute. It was a wise choice.
We blocked you. Yeah. profanity was limited.
I highly recommend having a look at the two links I put in there. The Elizabeth Warren's 2007 lecture, The Coming Collapse of the Middle Class, where she does exactly this. She tries to find out what has happened with the growth in misery. How the expense of living has changed from like the 70s to the early 2000s. And it's well worth watching. Also, that's simple 6-minute video of wealth inequality in America. And that's from 6 years ago too. It's gotten worse since then.
Oh yeah.
The thing that people have a hard time understanding, I think, the more unequal and less social mobility there is in the country, the less equality of opportunity that there is. And when we put financial barriers in front of things like education, that limits the supply of people who can take advantage of it. The more the inequality is, the less we understand how the other half lives. Servants know more about the masters than masters do about the servants.
That's thank you. Okay.
Look at home ownership. It went to nearly everyone after World War II with such programs as the GI Bills and and then now it's back to you can't own a starter home without help for most people.
Right. They get their parents to co-sign. The age of people that are signing up for homes, or it's like a record high, like 659 or something. It's gone way up. Yeah.
And that leaves out all of the working class, even the ones with parents, because they can't afford to do that either.
Yeah, we usually show we show something with the home ownership. We did it I think it was last month or the month before. The home ownership's about the same as it was before the pandemic. So
what do you mean the same as it was?
65% of what's the right way to say it? 65% of households own the home they live in.
Uh-huh.
And that number has
how
been,
does it move over time?
It was a little bit higher before the Great Recession because we had the housing bubble. And I think it got into the 70s. I don't have the data though back to World War II. That I don't have.
It wiped out pretty much all of the hard-won black middle class.
It did. It did. People that had the net worth of the bottom 50% group was vaporized in the Great Recession. And it just came back in the last few years.
But has it? Do you have any kind of proof that it has?
Well, I have the Fed data on it. Yeah.
But of that, where you didn't show any of that wipeout. Where was the wipeout?
No, I didn't. I don't have that chart in front of me. I can bring it, but it basically went close to zero. It was like 30,000 went almost to zero, and now it's about 60,000. So 30
for the
zero,
same people.
So
how about the percentage of ownership then? It had to have plummeted.
What you did? Oh, definitely. Yeah. I mean, and I'll get to the chart. I'll show it next time. And but the home ownership, I just wanted to say it's about the same as it was before the pandemic. Things have not gotten worse than they were in 2019, which was a year you didn't hear all this noise about affordability, at least not in the major media. Now it's a crisis that, it was a big deal for the election. It's still in the news all the time, but things are better than 2019 when it wasn't in the news. So
I think that affordability is a more polite term for poverty because it's more spread out to everyone. The middle class feels it too. But affordability has always been a problem for those in poverty.
Oh, well, yeah.
And the number of people in poverty, I do not show me how the number. Look at that 6-minute video.
Okay. Yeah, we'll check it out. Yeah. All right. Well, this is good. I mean, this is where is it? The wealth inequality slide I like to show is this one. and you got the bottom 50% with 4.3 trillion, and you've got the top 1% with 54. We talked about it. And in that top 10% have 2/3 of the net worth. And I would think we would tax the heck out of them to cover whatever we need to cover. But that is going to be blocked by Republicans. As long as there's Republicans in there, they will not happen. And how do you convince the middle class to vote for reallocation of this? A lot of them don't want to do it. It's pride. It's a pride issue. They won't do it. So, it's just an education and you need a compelling leader, somebody like AOC that can articulate the argument and do it. And we had somebody like that with Obama. We did not have an articulate explainer in chief with Biden. And now we need another one. We need somebody that's going to go after affordability and explain it in terms that people want to hear. We got a question. Dr. Chris is raising her hand.
Dr. Chris is calling.
Yeah, a couple things. So, I think there's some things regarding the presentation that probably we have to move on and maybe address at a later date when you can gather the data that was requested, just so we get through the presentation.
Yeah.
But the other thing is, I think it's important the language we use. Prior to the Reagan administration, I think even in the 60s, the top 1% was being taxed at the 90% rate. And then there was a substantial decrease during the Reagan administration, which really blew up the deficit. That was when we went into the debt, that was the start of our debt. So I'm going to offer this, is that I hate when we say we need to tax the rich or, whatever. What we need to do is make sure the top 1% are paying their fair share of taxes, because right now they are not paying their fair share of taxes. And we act like that's shocking, but if you look at the trend over time, when it went from 90% to then 80% to, I don't know, what did it go to during Reagan's? Is that when we got into the 38% range or whatever?
Yep.
So let's get to the 60% again, right? And then see how it all falls out. It's not that we're taking from the rich to compensate, for the lower 1%, if you will. We're having the top 1% pay their fair share, because there's all sorts of tax breaks right now that the rich get. And that's what we just need a fair tax system, is my bottom line.
Yeah,
that's all I have. Thanks.
That's part of it. No, that's got to be part of the discussion. One of my favorites is the thing called tax expenditures. It's the deductions, exemptions, and preferential rates, like a 20% capital gains tax rate, as opposed to paying the ordinary, up to 38 or 36 or whatever the top rate is. The top 20% get $1 trillion a year in tax expenditures. Let me say that again. The top 20% get $1 trillion a year in tax expenditures. If you eliminated those, you don't even change the rate tables, you just get rid of the tax expenditures. I don't know that you would bring in $1 trillion. CBO doesn't say you get it all, because people will change behavior and avoid, but let's say you get 600 or 700 billion of that. You don't even touch the bottom 80%. And all of a sudden the government's got another, somewhere near $1 trillion to spend on stuff for the middle class. So the money is there. I'm showing it to you here in terms of the net worth, but there is plenty of money out there that the government chooses not to tax. And as you know, Trump has done a lot of damage to the IRS, which I think was probably what he was trying to do with Dodge in the first place, was make sure they're not able to get after the rich people and audit them. And so there's a heck of a lot of money sitting out there that is owed that they are just not able to get at because the enforcement has been weakened. So go ahead, Dr. Sue.
Along the same lines of what Chris just said, every dollar that we didn't have, the rich being taxed at 90% for all these years, it had to come out of somewhere. It's not like, the country had, I don't know how much extra money the country had in the 1980s? You know, did it have a huge surplus and we were slowly drawing down that surplus because we weren't paying the 90%? No,
we've
it probably
always
had
been
a
in debt.
deficit.
Yeah,
Yeah,
we've always had,
it
but
probably
they
had
were
a deficit.
small. They
So
were
every
small and
dollar that we weren't paying, that the rich whatever percent weren't paying their 90%, is a dollar taken away from things like social services. What does that do? This is this is kind of like a fluid flow problem. Where does that go? Well, it goes because there are a bunch of kids with older parents who would normally be helped by social workers, but those social services got cut, and now those social workers only maybe help their parents like 5%, and the kids have to spend money to hire people to do the other 95%. And therefore, the kids actually don't really have that disposable income because they spent it on something that for the social workers that didn't have to be spent on before the 1970s or whatever. So someone has to go through and see this big picture and account for all of these inflows and outflows instead of just look at inflation numbers.
Okay, fair enough. All right, let me proceed with the presentation. We'll pause for now on the questions and we will keep moving. This was the inflation numbers for this month. So these numbers are how much more prices went up versus the month before. So in January of 2026, that's a 0.2 number. So times 12 would be about 2.4% annualized. This is where you can see clearly the sort of the break that we had because of the shutdown, where the inflation was around 3. And then we have this break and it comes down here into this 2.7, 2.6, and now it's down in here. So, you know, we'll see if that number starts to creep back up again, but inflation at this level is not a big concern. I mean, it's not all the way down to the target yet, but it's not a danger that anybody on Wall Street is worried about. It's not something where the Fed is worried that it's going to get out of control. They've lowered interest rates a couple of times and it hasn't jumped. So they are, you know, it seems to be under control for the most part. Now, one of the things that confuses the issue is the way that rent is handled. Rent jumped like crazy during the pandemic. People wanted different spaces. They moved out of the cities or they moved into places where they could work remotely. They wanted bigger homes. They wanted offices. There was a lot of different demand reasons. We also, toward the end of that, started to bring in a lot more immigrants as well that probably had some impact, a small impact. But it was mostly what I've heard is it's from economists is it was demand for space. People, we had a large creation of households around the time of the pandemic. People moved, believe it or not, moved out and got into different places. So what we've seen though is after this giant inflation, we had deflation and we've actually had downright or disinflation, which meaning the rate of inflation is coming down. Now we've got deflation, meaning the price of rent is falling. And that's what this graph shows on the right. Inflation, again, this is a national average. Not everybody's like this. Rent is coming down from that 2022 peak. It's not a straight line, but it's trending down. And there's some text down here from Apartment List on where these rents are. But what that means is that if the Bureau of Labor Statistics is saying the inflation for rent is, you know, 3% annualized for a year, that's not what the real-time data is telling us, which is actually rent is rent that is deflating. It's falling. Prices are actually falling, kind of like they've been falling for gasoline. They're saying rent prices are falling overall. That isn't what I showed you on that chart earlier, where rent is an increase and it's weighted very heavily in the index. So in other words, even though looking at the CPI number, you may say, well, there's some indications that this number is too low. If you were to look at real-time measures of rent is falling in price. That means this number probably in reality is probably not that far off the mark. I don't think this inflation should be 3 or some other number. I don't think it's far off, but that's just my view. This is the best we have from the Bureau of Labor Statistics. But it's interesting what's happening with rent. Rent is not skyrocketing. It is coming down slowly from that 2022 peak. And this was a real surprise to me. I didn't know this at all. It was not something that was in the news, and Karl and I look for this kind of stuff. The most important driver behind the soft market conditions, meaning the prices coming down, that have persisted for 3 years is a historic surge of multifamily construction. We're past the peak, but multifamily construction remains elevated. 2024 saw 600,000 new multifamily units hit the market, the most new supply in a single year since 1986. Now, I don't know if I were the Biden administration, I would have been touting those numbers. We're building a ton of housing, but we didn't hear any of it. So it surprised me to see that. So this is another one of those supply side economics things, that real supply side economics that Biden did. We had immigration to increase the supply of labor. We had infrastructure to improve to increase the supply of the things that businesses can use to be successful. And you had, this supply wave of housing for people. So there was a lot of this really interesting stuff happening behind the scenes that we just, even though we looked for it, we didn't see this one. But that was quite another feather in Biden's cap, is that this was happening. There was an interesting speech by the Fed vice chair a couple weeks back, and what he said is that rent and services, excluding rent, the inflation rate has been falling. Still, inflation is positive, but the rate has been coming down. So that's called disinflation. The rate of inflation is slowing. Deflation would mean negative, like goods down here. But look at goods prices. Goods prices, and these are where the tariffs are on goods, right? The tariff prices were falling very steeply then, the goods prices were falling very steeply, and now they're rising because of tariffs. And so what he said is that this is offsetting some of the benefits you're seeing in rent and services, is the goods are going up because of tariffs. And this is one study from the Federal Reserve Bank of St. Louis, a bunch of economists there. They're saying that inflation without tariffs would be 2.3% instead of 2.85. So it's about half a point of inflation that tariffs have added. This was late in 2025, or middle to late 2025. And then they're using different measures. So this is the headline PCE, that's the Fed's measure. And then the core is their preferred measure. That's the excluding food and energy. And again, the 0.5, in this case, 0.4 difference. So tariffs adding somewhere between 0.4 and 0.5 to the rate of inflation. So if you look at something like this, if you were to take tariffs out, these numbers would be more like 2.0, And I know you can't all read this, but the text is there if you want to read it. Also, the citation is here. Congressional Budget Office, which is your best source of information. They are the most credible analysts out there. They talk to the economists all over the place when they do their modeling. They are the best source you have. The price level will be 0.8% higher by the end of 2026 due to tariffs. So about a penny on every dollar you spend, you're spending a penny extra on every dollar because of tariffs. Consumers bear 95% of the tariff impact. Trump has been lying, and so is his administration, saying it's not, tariffs aren't borne by Americans. The foreigners are going to pay for it. It's always been a lie. The CBO just said, no, 95% of it's going to hit Americans. And then they explain the causes, which get a little more complicated, but are in here about how the mechanism works. And that's what you'll see in here. Karl went through the presentation earlier on those Congressional Budget Office slides. It's the budget and economic outlook. It's the best source of information on this sort of thing you can get. It's got tons of graphs and charts. It's the 10-year outlook, so it explains what they think the trends are going to be over the next decade. The only thing to watch out for in there is that they must, by law, they must assume current laws continue as legislated. So things that are already on the books will continue, and things that are scheduled to expire will expire. They have to do that, but still, you get very close to reality. And this is what they're saying. So inflation of almost a full point. So these guys said half a point. CBO said by the end of 2026, because more and more of these prices are going to get passed along that corporations have been eating so far, they're going to hit in 2026. And remember, corporations did an enormous amount of front running, meaning they bought a ton of imports in that first quarter area or time frame of first quarter of 2025. And they're just now getting to the end of that inventory, meaning they're gonna have to go out and buy stuff that's more expensive in 2026, and they're gonna pass it along. when they do that. So if we got a little bit, if it didn't hit us yet, it's gonna in 2026. This is the Tax Foundation, another think tank. That's what they say is that the tariffs are going to hit you about $1,300 a household. They're going to bring in about $2 trillion in revenue to the government, so a pretty big amount of revenue coming in. Gross domestic product will be a little smaller because of the tariffs, which make the economy less efficient. And then about 500,000 jobs less than otherwise. And that's kind of an interesting figure because we just saw that they got lowered by about 400,000 for 2025, but they're talking about down the road, about 400,000 fewer people working than otherwise because of the tariffs. This is the Fed's PCE inflation. So 2.0 is their target. This is the core is the number they use, but it turns out the core and the non-core are about the same, about 2.8%. They want this to be 2.0. So when people say the inflation rate's a little above target, that's what they're talking about. So if the CBO is right with that 0.8 number, by the end of 2026, if it weren't for tariffs, we'd be at 2.0 probably. This is an important measure that the Fed uses to see our inflation expectations getting out of hand, meaning our investors expecting more of a return on their bonds because inflation is expected to be high. And it's been bumping around in this 2.0 to 2.5 range, and it's elevated temporarily, and this gap has increased a little bit. So the 5-year has separated from the 10-year a little bit. What that means is in the short run, people think inflation is going to be a little bit higher, so they're demanding higher interest rates on their short-term bonds. But in the longer run, they're not. They think it's going to get under control. And Karl shared the CBO forecast, which indicates they think by 2029, the inflation will be back to target. It would be just back there a lot sooner if it weren't for tariffs. So even though the Fed is lowering its short-term rate, these numbers are still kind of, they're still, I shouldn't say that, because they're lowering their rate and stimulating a little bit, these numbers have come up a little. And so the Fed's going to be watching that to see if these start to break upward. But right now, these are manageable numbers. You're not seeing investors panicking about, the Fed cutting rates over the next couple of years. The Fed has another big tool at their disposal, which is they have what's called their balance sheet. So you always hear about interest rates in the news, but the balance sheet is the sum total of all the assets that they have bought, all the bonds that they have bought. So there's treasury bonds in there. There's mortgage bonds that they buy from Fannie and Freddie. They've got some other kinds of bonds in there. And what they've been doing is they dramatically increased this number for the pandemic. They doubled it basically. Well, more from 4 trillion. This is millions of millions. It's trillion. So $4 trillion up to 9. And now it's back down to 6 point something. What this is doing is working. This is almost like increasing interest rates. It slows the economy when the Fed does that. So, and I've explained some of that over here about what reducing the balance sheet means. That ended in December. They're sort of going to go sideways for a while. They're not deliberately lowering their balance sheet anymore. They're not selling net. They're not a net seller of bonds anymore. They're going to work sideways for a while because there were some liquidity concerns. And this gets really complicated into repo markets and all kinds of stuff that I barely understand. But they are stopping the decline for a while at least. But what this was doing is even though interest rates were going down, this was working contra to that. This is going the other direction. This kind of the interest rates going down is stimulative. This is contractionary. So people don't watch this, and so it's not in the news. That's why you don't hear Trump talking about it. He talks about interest rates, but the Fed has another important tool for managing, for trying to address inflation. All right, so let me stop there. What questions do we have about that section? Anything, Debbie? Have we worn people out? It's almost 9, so we've been going for quite a while. I'm just going to look real quick to see if there's any other slide here let me share these two and then I'll stop. What we are seeing is loan delinquencies are starting to jump. They had been very historically low through the pandemic. Obviously, student loans didn't have to be paid back for a while, so these numbers got very low and now they've been climbing again. So auto loans, the green line, back near, and this data goes back about 23 years. So pretty close to the highest in 23 years on auto loans. We talked last month about how crazy the prices are for cars. Like a new car averages like, what was it, 50 grand? A used car is like 25. I mean, these are nuts, crazy numbers. And now because the student loans aren't protected anymore, that number has jumped. People aren't paying those. And credit card debt is climbing as well, back toward where it was during the Great Recession. So these are not good numbers for how households are doing. The Fed does a great report. It's down here. It's the quarterly report on household debt and credit, if you're interested. So almost all of our slides have the citations on them of where we get the numbers. So this is a very picture-oriented thing. It's not long and complicated in terms of the text. It's just tons of pictures. And the good news coming, I wanted to end on a happy note, which is the Trump tax cuts. You should get, the average family is going to get about $800 more in tax returns in 2025, thanks to the law. What Karl and I said earlier is that because of the tariffs, and I mentioned that costs somewhere around $1,300 to $2,000, and people, part of this law, the tax law, also takes away some Medicaid benefits and some of the SNAP benefits, that the bottom 80% are worse off. But at least when you look just at the tax return, you're probably going to get a bigger tax return this year than you have recently. So I guess on a good note, enjoy that. Some good news coming in March. So along with all the bad news that you hear. So I guess we can open it up to questions on any subject, and I will end presenting here.
Okay. Would you like to take hand raises now, David?
Yes. Any
Right.
questions, comments? You know,
Okay. If
talk them
anybody
out so
has
you don't damage any of your computers or screens or anything else.
Yes, yes. Raise hands lightly.
I always tell people I drink heavily before these meetings. Oh, this is actually water, but these are, it can get rough in this
Okay.
meeting.
Looks
We
like
are
Hannah's
going
the
to
first one to
Hannah.
raise her hand.
Yeah, Hannah. Go ahead,
Hello.
Hannah. Hi.
Hi. Yeah, Hannah here from Lindenhurst, New York. I heard today a report from California that the voters are being asked to pass a 5% wealth tax. I wonder, have you heard about that yet? I don't know how formulated the actual measure is. I'm sure it has to be, since they're asking for signatures. Like, what are they going to assess that on exactly?
Yeah, I have not looked into it. I don't, Karl, have you, or has anybody else done it?
I just read something about it the last day or two, and I have not dove into any depth to know what the specific proposal is.
Right.
One
Yeah,
of the
because
challenge. Oh, go ahead.
no, I was just gonna say they had an anecdote from one of the billionaires that lives there. I think it's like 200 billionaires or something like that. And
Yeah.
I don't know if I heard it right, but that individual was lamenting some of the highest taxes paid by them across the country, I guess, as a percentage. But I thought I heard the person say 13%. I don't know.
Yeah, no, we'll look into it. That's a great question. I mean, if you were going to do a wealth tax nationally, first of all, let me say this. If it's only applied to residents of California, people will move, right? It's a lot of them will move. Not all of them, but a lot of people will relocate. If you do a national tax, what you would do is you would have the people over a certain threshold, and the top 10% threshold is my favorite. It's 2 million net worth. If you have people with 2 million net worth and over, so the top 10%, file a net worth statement with the federal government along with their tax return, and they pay some percent of that as the wealth tax. And it would be, you could graduate it, meaning a person that's right at 2 million might have to pay 0.3. So they pay $6,000, and a billionaire pays 10%. They pay $100 million. And, some of these people, some of the billionaires have hundreds of billions. I don't know what Bezos is up to now or Musk, but I mean, they've got hundreds of billions and their wealth is probably still going to go up anyway, because I showed you the stock market basically doubled in the last 6 years. So if the stock market's going up 15, 20% a year, they can afford to pay a pretty sizable wealth tax and still see their wealth grow.
Yes.
So and it's a huge amount of money. I mean, I showed my favorite chart with the bars. The top 10% have 118 trillion net worth. So if you set up that tax to be 1% of that on average, graduated at the bottom, heavy at the top, but to get $1 trillion, your deficit situation basically goes away.
Right.
You don't have a deficit problem anymore. And again, that's the top 10%. You're not even touching their income. You're just touching their net worth.
Right.
And they might get richer anyway.
Yeah. They were saying they're trying to plug a hole in something with healthcare. I don't know what's going on with that. But the individual, again, it was SEIU, I think a person, the healthcare worker union person was speaking to it. Yeah. And they said the only thing that was detailed in their discussion of how it's actually going to work, they said they're going to assess this payment based on anyone with a residence in California as of January. So it's too late, man. Even if you want to move in November,
you get them the first year, right? Yeah.
You got to pay anyway.
That's right. You get them the first year. And I don't think they would get away with something like, because I think they could try this nationally. I don't think they get away with it at the state level. But if the government came up with a law that said, if you leave the United States, and you have a wealth tax, you have to pay some amount. Like you might have to pay 20% of your net worth if you're over a certain level and you leave the country. But you're going to run into constitutional problems with a wealth tax, which is why I think ultimately you're going to have either you have to pass a constitutional amendment, which is almost impossible nowadays. I can't imagine. But if you were able to do that, or your better bet is to just raise the rates like one of the doctors was mentioning, or you raise the income tax rates, you remove the cap on the payroll tax, and then you also get rid of those tax expenditures that I was talking about for certain people, for the richer people. You can get close to getting your deficit under control without touching the bottom 90% of the population. The money's there. So we'll see. I see Nicole.
Yeah,
Gretchen.
Gretchen has her hand up first, so we'll go to Gretchen. Go ahead, Gretchen. Here you go.
Great, thank you. First of all, fantastic presentation. Really enjoyed it. I've got a couple of questions, and I'm going to try and keep them focused. The first question is, on paper, this looks great. How are other countries viewing us as far as investment? And the question I keep hearing that all of the countries are dumping American bonds and we're going to collapse because of it. My second question is, how much can the states influence, California in particular, which has said many times, I think California is the fourth largest worldwide economy. How much can the states change the metrics if they go after things themselves? Like Gavin Newsom is going after working with other countries directly. What the US usually does, he's going after it as a state because he's got a big enough economy to do it. We're going to end up with a really polarized America. And I'm in Parsons, Kansas.
Yeah.
So, all right, Rick.
What's wrong with you? What's wrong with Kansas? What's the matter with Kansas? Yes.
Well, right now we're burning. I was looking at all the wildfire data, which is really scary.
Yes. Oh, no.
Anyway, two huge questions. Thank you very much for tonight, and I'll let you talk.
Sure. I can't help you with the second one. I got to think about the state and what they're doing. I don't usually deal with state stuff very much. Let me think about that one. On the first one, that's a question that someone always puts in the chat. Every month, because it's what happens if the rest of the world dumps our assets, right? It's a great question. It's been a sort of a boogeyman that's out there and has been for a while. I would say that it's possible that countries will not want to buy our stuff. But let's look at some indicators. I showed that Federal Reserve balance sheet that it's declining. If the other governments were not buying our debt and we could, and the government here, the US government had to somehow finance itself, the Fed would be buying all that stuff. The Japanese government has been doing that for a long time. They buy the Japanese bonds. That's not what's happening right now. The Fed is shrinking its balance sheet. The other thing is interest rates are still pretty stable around where they are, like the 10 years around 4% and has been for a while. If those interest rates start to climb, that would tell you that there's a problem where people are dumping the bonds. So the price of the bonds are falling, which means interest rates go up. Prices and interest rates on bonds go in opposite directions. And so if there's a bunch of dumping out there, you would see interest rates climbing more than a little bit, right? And Wall Street freaks out when things move like tenths of a percent. But I mean, realistically, if the 10-year went from 4 to 5 or 5 to 6, then the problem you're talking about is something that's reality. Right now, it's a risk. It could happen, but it's not happening yet. So, you got the interest rates to watch, you've got the Fed's balance sheet to watch, and then you'll be able to see if it's actually happening. If you really get wonky, look up, and I've never been able to understand them, so I'm telling you, it's really hard. But there are some people out there that are really good at interpreting Fed auctions. When the Fed auctions off the debt, there's a bunch of investors that bid on it and all this. And if you look at auction results, you might see that would be like an early warning of all this. But in my technical level, I don't even know that stuff. It's like interest rates and the Fed balance sheet. I'll know if it's happening there.
Yay. Well, Nicole has a question for you, I guess, no? Okay, Nicole, go ahead.
Yes, hi. Regarding the California tax on the rich, they were going to tax 5% one time on people who have a net worth more than 1 billion. And the billionaires have already fled to Florida. Yes, Zuckerberg bought like a $280 million house near where Ivanka's home is. Florida doesn't have any income tax, and they're planning to submit to the voters something that would eliminate property taxes.
Yep.
So it'll be like all the renters and all the poor people that will be paying, the rent that we be paying for the infrastructures and things like that. Always the poor.
Of course. No, thank you, Nicole. Those are good points. Yeah, think about it this way and I've seen this from Republicans every now and then. They talk about getting rid of the property tax. If you think you've got barriers to home ownership now, imagine what happens when there is no market. Nobody is going to give up their property. And they're just going to have to somehow, whoever owns land is going to just be I'd have to it's not going to happen, but just it would be a permanent underclass. It would be like serfs and the nobles of the Middle Ages. I mean, it's ridiculous, the idea. And the thing is, there's the majority of households own their homes. 65%, as we were talking about earlier, own their homes. You could see a majority go for that. And I don't think it'll ever happen. I just don't think it'll happen. But a majority of people might think it's great that they don't have to pay property taxes anymore. But who's going to fund the schools? You're going to have to come up with a school tax. You're going to have to come up with some other way of funding all this stuff. So I just don't see it. And we would be fools to do it. It would just be an incredibly revolution driving thing. There would be a lot of blood in the streets if we had serfs like that. There's enough angry people now on affordability. It would get bad if we had no property taxes. There would be guillotines out there.
Ooh, not an enlightening thought there, David.
Oh, no, it deserves a better answer than I just gave, but it would be bad if you had no property tax and people just sitting on their property. Oh, I mean, no.
Yeah.
No, you'd also have a lot of pressure on the government to sell a bunch of land for new houses and giving up the parks and other places, selling all that stuff. And
Okay.
I don't see it. So,
All right. We have Rita with her hand up also.
Yep.
Now we can go to Rita. Go ahead.
I'm going to come back to something that I learned about in law school. We have enough regulatory constraints on the books that have not been followed through at all. I don't care if, Elon Musk takes a chainsaw to whatever. Those are still laws on the books. When we take a look at the situation we're in right now, the flashing red sign that I see is we've got the regulations. Why are they not being enforced? We know that under this administration ain't going to happen. Right?
Yeah.
But this was going on under Biden. This was going on under, I love him, but it was going on under Obama.
Yeah.
It was going on under Bush. Now we're sitting here looking at monopolies. So if we want to talk about that 1%, guess how they got there?
Right. Yeah.
Ignore all the regulations,
Yeah.
never pay fines, etc. How do we get that to turn around? And what would be the economic impact if we got it turned around?
Yeah. No, that's a really good question, and I have to study up on this. I did years ago, but think of it this way: and even there even is some common ground with conservatives on this, in that a monopoly is not the free market. It's an abuse of the free market, right?
That's what Roosevelt said. He made the point. He got the laws pushed through. He got the regulations on rolling. And what did we do?
Right.
It's the whole thing on history, right? Learn it, learn it, or you're doomed to repeat it. And here we are.
Yes. I mean, if you don't break up monopolies or oligopolies or whatever term you use, oligopolies is like a few companies that act like a big monopoly, like a monopoly.
Yes.
I'm not using technical lawyer terms, pardon me, but that's what I use.
Let's talk about offshore accounts.
Sure.
I mean, you want to go someplace interesting for a holiday? Try to get into Luxembourg.
Yeah.
Luxembourg is the westernmost Swiss bank unit country in the world.
Yep.
And you have to be invited in to go there.
Sure. Now, if there's some tropical islands too in the Caribbean that are like that as well. I can't name them right now, but I know there's a couple of them. And good luck getting in there. But that idea that there might be common ground with conservatives on the monopolies and the trust busting, it's also a popular item. You need a really good communicator to explain it. You need an AOC type communicator that can explain this sort of thing. But there is common ground there, because if you're a free market conservative, you're good with breaking up a monopoly. And Reagan has sort of brainwashed people into thinking deregulation, government should not act or do anything. And it's like, no. The free market is competitive, and you want to break up the monopolies. And we have to go after them and figure out where they are and sue them and break them up. And that is hard work, and that's a Teddy Roosevelt kind of thing.
Great.
We probably do, right? Every century we go back and do it.
How would that affect our economy?
Oh, it would be a big win. I don't know how big, but it would be large. I mean, it would be a very big efficiency improvement if you were to get rid of monopolies and oligopolies. Very big. I'll get that's a good. I'll take it as a to-do, and I'll look into it. We did years ago, but it's been a long time. Obama started to talk about it, but he didn't.
Yeah, I would appreciate it, specifically because, again, we talk about what are the symptoms. Look at what we've got right now. We've got a lot of symptoms.
Yeah.
What's the cause?
Yeah.
If you don't address the cause, you're stuck with those symptoms forever.
Yeah. Yep. Good. No, great observation. Thank you.
You're welcome.
Thank you, Rita. All right. What would you like to do, David?
I need to drink some more. Something stronger than this water. And no anymore. I see one hand up, but that's Bill Davis. He's a
That's
ringer.
Bill. Bill's going to add something. Go ahead,
Yes.
Bill.
Well, I think if I've figured this out, we're at the end for tonight's presentation.
Yes. Thank
I
you.
just want to let everybody know that we have been doing this particular program since 2012, about March or April of 2012. So it's been going on for quite a while, every month doing a fiscal and economic program. And it just gets better. And it gets better because of the people who attend. And it gets better because people ask the questions that are on their mind. Some of them are really easy. Some of them really make you kind of think. And David and Karl get better. And it's hard for me to say, but they actually do get better because they have to answer those questions. And they don't take it lightly. I'll get questions from them during the month. Do you remember the person that said such and such? Or I looked this up and here's what it is. So enjoy the opportunity to come here and just ask the questions and be part of the process. I have always found that if I send David or Karl a question, it may be when I'm in my back porch arguing with my son-in-law about something, that they almost immediately give me an answer. I don't abuse it, but it is kind of neat to be able to have the expert. And when we advertise this, we say it is the longest running U.S. economic conversation, monthly conversation in the U.S. And to the best of our knowledge, this is the best and the longest one that where people can actually interact. So that is neat. So if you enjoyed this, tomorrow, there is tomorrow. We start at 9 a.m. Believe it or not, we start at 9 a.m. with coffee and conversation, 9 a.m. Central. Same Zoom link that you used to get in here. So, and it's just a conversation. 80 to 100 people will join. They raise their hands. They tell people what's on their mind. They'll post articles, and we'll have an hour of formalized conversation. And then there's a little ditty we call the after hours. Some folks that just kind of stay on to kind of have a further in-depth conversation. It's really quite cool. And then tomorrow, typically, we have at 2 o'clock our how-to hands-on session, which is how to use technology day to day. It's for people who are just learning how to use PowerPoint, people who are just learning how to use AI, etc. And typically that's at 2 o'clock this time. Tomorrow, I actually don't know what we're going to have on there. It could be Ed Spire talking about how he creates presentations from the news of the day. It could be Rebecca, who's typically joins to talk about the various trips and traps in using your emails these days, not to get followed or whatever, using Signal and other areas like that. Yeah, thank you. That was just coming out of my mouth. So tomorrow we don't know. We may cancel tomorrow at 2 o'clock, or we may have it on. I'll let you know more in the morning at Coffee and Conversation. And then on Thursday, we do the same thing. We have every Monday through Friday, we have this Coffee and Conversation. And then on Thursdays, just to keep everybody who is an Indivisible member, there is a coffee time at 2 p.m. in the afternoon with Ezra and Leah, who are the co-founders of Indivisible. And they just take questions from people. They talk about what's coming up, like the No Kings 3, etc. So that is really cool. And then at 5 p.m. on Thursday, we have what's called sorting soup. And as you know, there's all different types of soup and all different types of conversation. This is the Sorting Soup Book Club. And they've been finishing up now, reviewing the GOP Project 2026 and what it means and how we can resist for what's happening. Very conversational. They read pages, then they discuss. Also, on Thursday at 5 o'clock, the same time, we have a Zoom going on with our ethical standards. And we have a speaker that is well known in the United States to talk about disinformation. So, two things: sorting soup and disinformation. And that is a separate Zoom link. So it's Sorting Soup is our Zoom link. This ethical on disinformation is a separate one, but you'll find it on our website, and you'll find it on our Facebook page, and you'll find it on our weekly What's Next that we put out. And then Thursday evening at 7 p.m., Edspire is going to be doing a presentation. Those of you who know Edspire understands exactly where he comes from. It's an hour and a half packed. Hour presentation, half an hour of questions. And it's going to be on immigration, where we are today. It's going to be on ICE, where we are today, and how important immigration is to an economy of a country. So he'll do a nice job wrapping that all up. And that's all I'm going to go into. As you can tell, we do about 3 programs a day at NWSOFA. We stay true to our mission to give you the facts, to help you understand what's going on, and then to be able to present those facts out there. So if you have time and you're looking for a really fun time, you can go up to the NWSOFA .org website, NWS Northwest Suburbs OFA Organizing for Action .org, and click on our YouTube, and you'll find this video just finishing. It's a 35-second delay from the actual thing, and you can send this video out to people. You can review pieces of it. If you're thinking, I kind of remember that David, right after the break, he was talking about what the economy means for each sector of the wealth gap, and you can find that. And then if you're really into pain, you can go back and you can review the last 5 years of videos on this. And they've gotten better. Anyway, I just wanted to put this plug in. I see Nicole has her hand up. I'm going to hand it back to you, Debbie, and
Okay.
I will disappear into the sunset.
Into the background, yes.
Yes.
All right. Okay, Nicole, go ahead.
Yes, regarding somebody mentioning what would happen to the United States if people dumped our bond and something. During the fight over Greenland, I heard one gentleman, I couldn't figure out who that was because somebody put his video without putting his name, but he quoted 2 other people, and he mentioned that if the United States were to declare war against Denmark, the Europeans would dump the bond or whatever they call it, the nuclear option, and the dollar would go down like to 35 cents to the dollar, and we would have a depression worse than 1929. And it seemed that somebody explained that to Trump, in addition to the stock kind of dropping, and that's why he backed down on the Greenland takeover. So I'm trying to find that video again, but I haven't been able to. And another thing that seemed to confirm that, somebody said that the United States might be planning to wipe wipe off our $35 trillion debt without paying it down by using the coin as part of our reserve, like the gold that we have, and transforming the equivalent of our reserve to a dollar or something like that. But that would make our dollar, our dollar become worthless.
That won't happen. Yeah, but that's yeah, the minting the coin, as they call it. Yeah, it's an interesting MMT intellectual exercise. It's not something likely to happen, but it's yeah, that it's out there. I've seen it. If you're interested in that subject, look up, the Fed minting the coin, and there'll be some interesting MMT related items that explain that.
Okay. All right, David,
right.
we have Pamela with her hand up.
I don't know if I can survive another Pamela assault.
Let's see, Pam, what you got?
Oh, I'm so sorry, but I don't think it was the MMT minting of the coin that she was talking about. I think she was talking about the transfer of the United States monetary system into crypto, which would be a disaster because we would no longer be able to deficit spend.
Right.
And they're trying to do that.
Yeah.
And that will empower criminals most of all. We've got to keep the dollar as the United States currency. I think we don't have to worry about constitutional conventions because the Republicans have figured out that you don't need to change the Constitution. You can just ignore it.
Unfortunately.
Bill, did you leave your hand up for a reason, or is just
That's okay. I can put it down for him.
That's right. Well, thank you guys. We appreciated it. This was the monthly meeting of the Northwest Suburbs Organizing for Action. Thank you again for all your questions and comments, and the presentation's there for you with all kinds of sources in it for you to research over the next month, and keep bringing the good questions, and we'll address some of these topics in the next session. Thank you.
And David, are you going to save the chat too?
If you look at the three dots that are in the upper right corner of the chat, you click on that and it'll say save chat, and you can save the chat. The problem I have is when I click on that, I'm not sure where it goes. So Christine was able to explain that to me before.
Did you want me to save it for you and send it to you?
Yes, if you can, or if you remember how it works, like where do I find it?